Peter Rose, Longwood Currency Trading. How to evaluate Forex trade uncertainty is the topic that I'd like to cover today. And this is actually the first day. It's been pretty nice out. It's 17th of April in 2022. And we're starting to get some nice weather. We've had a lot of rain, and as you can see, and probably, hopefully hear, the brook as it's coming down through the come down off the hill. That's pretty slick. We're very fortunate. Who has a brook running through their property, right? And last year during this time, we had a nice video about change, and it was part of it was the marigolds that were coming up. And as you can see, I'll have a better still picture of that later, but Sue's flowers are just starting to mature, and there's the empty wood pile that is no more. So it's heralding spring, and so the uncertainty of when that's going to happen has become less because of the evidence that spring is out here now. Even the Bo dog is appreciating the spring. Right, Bo? Let's go inside. We're going to go back inside. As someone who studied physics, there's a thing in quantum mechanics called the Heisenberg uncertainty principle. It deals with, guess what, uncertainty. And that uncertainty principle states that you can know where something is, but you can't know where it's going. Or you can know where it's going, but you don't know where it is. There's some kind of qualitative understanding that you can apply to that if you really want to dig into it. The mathematics is quite complex, and so do we want to apply all that complexity to the currency markets? Well, the currency markets are complex in and of themselves, and certainly a lot of people have tried to apply mathematical models to the solution of price action, and there is none because price action is random. So I'm going to go on to the whiteboard and just look at this simple problem of Forex trade entry uncertainty in its simplest form. Just really briefly, we got a simple diagram here. You notice I don't put up real charts and diagrams because then the tendency would be for you to try to directly match on your charts what you see on these charts. And I talk in terms of principles. And so we want to look at principles. How to evaluate Forex trade entry uncertainty. Here's some squiggles representing price action, yeah? And we can see that price has come up, and it's kind of been in this thing, and we're currently right here at this point here. That's our decision point right there. And so the uncertainty here in a macro sense is where is price going to go next? But more importantly than that, where is price going to go in the long term? So let's look at that. We've got, and if you've seen any of my videos, you've seen me do this before, and I do it in other lectures and mentoring. But it could go that way, it could go up, it could go sideways, or it could go down. You get a 33% chance it could do that, a 33% chance it could flatline, and a 33% chance it could do that. That's the uncertainty from the long-term standpoint. Will it continue moving up as it is? Will it move sideways, which it has a component of sideways movement here? And obviously it came up from somewhere, so maybe it could be going back down there, and you have this 33% chance that it could be doing that. Well, in our analysis, and I'm going to go over some of this stuff relatively quickly because it's not teaching entry theory. We're talking about entry uncertainty. And so let's just make the assumption that we have the necessary data and whatever in order to say, well, what we have here is a rising, that is really a dramatic rising price, yeah. Love to draw. So we have rising price. What does that mean? Well, it means that it looks like, from an arm waving standpoint, that it ain't going to go down. That the probability is that it's not going to go down, that it's not going to flatline, but you have this gentle arc up, and so this 33%, you would say, well, I've got a 33% chance that it's going to go up as equal to all the others. But we've negated these. So does that mean that we have a 33% chance that price is going to go up? No, because we have negated this 67%. It means that the 67% in our favor, 67% in our favor, the price is going to go up over the long term. Now, long term is relative. It could be 3 candles, 5 candles. 3-hour candles could be a whole lot of 5-minute candles. There's 12 5-minute candles in an hour. So long term could be whatever time frame you're trading on, meaning that this trend it's going to be a trend. We could define that as a trend. Our next consideration in uncertainty is, well, we're right here right now. This is what's going to happen in 15 minutes or 5 hours or whatever time frame that you're on. But we're here right now. What could it do? What could it do right now? Well, right now, it's going to do one of two things. It's either going to go up or it's going to go down. It's 50% and 50%. Why does that change? It changes because in this distribution, you're looking at many data points, many throws of the dice, many whatever that you want to talk about. In this instance, we're looking at the next throw of the dice. In the next throw of the dice, it's either going to go up or it's going to go down. It's not going to go sideways because it doesn't do that. Price is either going to go up. Now, the price may go up a half a pip, or it may go down a quarter of a pip. It may go up 5 pips. It may go up 100 pips. You don't know. But it's either going to go up or it's either going to go down. Now, because of our initial analysis here that says, oh, okay, well, we've got a rising trend, then we should say that we have a 50% chance that it's going to go up, which means there's a 50% chance that it could go down. Doesn't matter how you think about it, but you have to subtract off 50%, and you end up with 17%. Rough, raw arm wave probability. I'd take a 70% probability of success bet all day long. Now, there are other factors that are involved here. For example, if this particular price right now is very close to, let's say, this point here, which would be a support zone. Strong, let's say that it's a very strong support zone across here. Are you going to take that bet, even though all these other things can figure in? Are you going to take that bet that you're going to go long at that point, when faced with this ominous situation here of this really strong support zone? I don't think you'd want to do that. However, if you go back in time when price was way up here and now it's just come down and now it's starting to arc back, and let's say you've got a zone up here like that, and the distance from your let's do this in green so we can separate it out. The difference here in the green take point and this point here is 30 pips. Sorry for the writing and all the glare on the board. We bought this house because it was bright and sunny. I don't want to close it down with shades just to do this. So we got 30 pips. And if you've watched my other videos and things on a 5-minute chart with a 5-period ATR, I want to be done in 2 hours. I'm looking for opportunities that present 20 to 30 pips, or I'm not going to take the trade. So here we've got the 30 pip of running room, real estate, in order for this price to continue to go up because of this proclivity here. So that is eliminating the uncertainty of the entry itself. Now, the next determination that you need to make, really, I mean, obviously then you have to decide on your stop. I don't have to decide on my stop because I've already decided I've got a 17% probability that I'm right. Well, I've got a huge probability that I'm wrong, and I'll be wrong 4 out of 10 times. So I want to make sure that I manage the only thing that I know how to manage, and that's my loss. And so I set my stops tight. Now, other people argue with that. They'll want to say, well, you got 30 pips or a runway room. Let's take a 30 pip risk. I think that's crazy. That's just my opinion. There's a lot of folks that work with this stuff, and they're very successful at what they do. I don't think it's a simple way of doing things. If you say, well, you're just going to get stopped out a lot, then you don't understand the rest of this, and you don't have good metrics in order to judge whether that's a correct statement for you or not. For me, I am going to get stopped out a lot, but not in relationship from a probability standpoint. If I'm a 60-40 trader, then that's not getting stopped out a lot because I still have the difference between the 60 and the 40, the 20. And so if I get stopped out at 10 pips 4 times and I make 15 pips 6 times, I'm way ahead of the game. If I make 8 pips 6 times, you just got to figure out what your ratios are and how those are interacting with each other in order to determine whether the uncertainty is resolved not only by this, but also by your win-to-loss ratio, your average win rate value, and your per trade win value. Those are all 3 different metrics that you need to be aware of. And I've talked about win-to-loss, I've talked about average win value. In earlier videos I did talk about the average per trade value, but I'm not teaching entry theory here, I'm teaching uncertainty principle here in regard to entry theory. And so therefore we started with the fact that we have a rising trend, and that knocks out those 2 probabilities. So we can say that we have a 67% chance then that it will go in this direction, and we take off the 50% immediate short-term uncertainty because it's jump ball. We don't know. So we have to subtract whatever that is. So it's very, very important that you really understand this value. This is always going to be 50%. If you've got a 50% thing here, which is going to be evidenced in your win-to-loss ratio, then you're taking a 50% probability of success and subtracting from it from a 50% probability of failure, and you're ending up flatline. You're no better than throwing darts at the board. And so if you don't understand the math of this, which a lot of folks won't, they need somebody in order to explain this stuff in real time with them and how to work through it so it isn't quite so complicated. It's the first time you're seeing something like this. It might be a little daunting for you. If you're very, very technically inclined, you're just going to go, that doesn't make any sense. I've got a degree in physics. I spent 33 years as a software engineer. I've been in real estate for 40 years. I think I know what I'm doing. So the uncertainty of the trade is not just here. The uncertainty lies in 2 parts. Where is it going to go in the longer term, and where is it going to go right now? And you need to combine those 2 uncertainties, or the probability of success and the failure of the other one, because that's the only way that you can determine, based again on your win to loss ratio, your average win value, and your per trade win expectation, as to how valid this number is. This is just a raw number. That's a spit in the pot number. It's just an abstraction. Everybody has this. You can look at this chart and you can say, I've got 17%. And you do at that point. Until you start looking at where's your support and resistance lines. What kind of structure is surrounding that? Is there a structural point where you could get stopped out before your stop? Let's say my stop was 8 pips, and here's 8 pips for argument's sake. But I've got this structure here, which the price would probably bump into before the 8 pips. So I would be cutting my risk too short. In other words, the probability of me hitting the risk before it can go far enough. In other words, there's going to be some flutter. So that would be not a good trade. What do I mean by flutter? In other words, the price is going to fluctuate. It'll go up a little, come down a little, go up a little, come down a little. And the going up and the coming down is a function of the momentum of the price action at that time. And momentum is order flow. It all gets back to the fact that you and I, as retail traders, are not running this game. The institutional traders are. We're only 15% of that mix. And so for us to play in this game, we can't be thinking about what the retail traders are doing. It's what the institutional traders. The institutional traders aren't worried about this. The institutional traders aren't worried about this. The institutional traders are out here. The institutional traders are out on the 4-hour chart or the weekly. That's where they're at. But they're not looking at anything below 4-hour. They're executing maybe at the 4-hour, but as far as their overall campaign, they're out on, depending on how big the order is, right? They're looking out days, if not weeks, of time in order for them to distribute their $2 billion or $5 billion client order into this market, taking into consideration different probabilities way out there than what we as day traders are dealing with in here. And boys and girls, if you're trying to get into this new and you're listening to these people about looking for 100 pip profits and taking 100 pip stop loss events or making 30 pips a day, you're not going to be successful. 90% of you are going to lose 90% of your money in 90 days. And the reason for that is the education that you're getting out there that's wrong. You have to start simple. You have to start from a framework. And you have to base that framework on the order flow, not back fucking patterns or Fibonacci numbers or all the other crap that's out there. In any event, how do we evaluate Forex trade entry uncertainty? Deals with these two areas of immediacy. Whether you're a long-term trader or whether you're a short-term trader, it doesn't make any difference. It's trade entry. If you get the trade entry wrong, you're screwed. If you can go through visually this stuff, and that's what I do. I look at the thing and I go, how valid is this? You know, you might have a long period of this flatline stuff. In this 33, you may find that that's a 48%. Well, Peter, how do I know the difference between whether it's 33% or 48%? That's a course. That's why you take a course or you take consulting from somebody. In order to evaluate Forex trade entry uncertainty, you need to start with where you are right now at the hard right edge and work your way from there as to what the probabilities of your success are based on your past trading metrics as well as past price action, but not using indicators. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.